Morning and welcome to our Alquity webinar today. I do hope you're all well. The topic is emerging markets. Should you buy more or will they underperform developed markets in 2022? At least that's what I read. The main presenter will be Mike Sell, the head of active equity here at Alquity. The presentation will take about 25 to 30 minutes, depending on what gear Mike is in. And then the Q&A will take about 10 to 15 minutes, depending on what gear you are in. So all in around 45 minutes max. Now, please do ask questions, as many as you like, but via the Q&A tab. I will then compile these at the end of the main presentation to put to the manager. Please note, I often get questions via the chat function, and as much as I like a good online chat, especially while Mike is speaking, please again keep them to the Q&A tab if you can. My name is Alex Boggis. I am the UK Sales Director for Alquity. If you've joined from across Europe, your representative Mark Rugel is also on this call. And if you're joining from Asia, then note that your representative Suresh Mistry is here too. We would all be delighted to hear from you after this presentation. We are at your service. Now, before I hand over, I'd like to reiterate that it's very important to us at Alquity that we perform well for our clients. Most of you will recall that we made some risk and portfolio construction changes as part of a bigger package of improvements in early 2020. These have delivered in a major way. We've seen very strong risk relative performance consistently month on month with lower volatility, and of course, whilst providing clients with a top quality, non-greenwashed ESG portfolio. Alongside this, we've never stopped donating our minimum 10% of revenue, and for some clients 40% of revenue during COVID, to the foundation for helping those in the poorest parts of society within the markets that we invest. So if you're looking for a new manager in the EM space or one to balance your existing manager, we are the people to call, preferably straight after this presentation. With all that said and done, and with no further ado, I'd like to hand over to Mike until the questions and answers. Mike, please go ahead.
Thanks, Alex. And let's move on to the next slide. For those of you that don't know me, I'm the head of emerging markets here at Alquity. I've been investing in the asset class for over 25 years, and I've been at Alquity now for coming up 8 years. And there are 4 things on the next slide I'd like to go through this morning. Firstly, a quick retrospective of the year that was 2021. Then to focus on the hidden opportunities that we see in 2022. Then to focus in more detail on perhaps the 2 most topical markets this year, China and India, and the outlook we see there into next year. Then to focus on why Alquity is unique, and then to conclude with Q&A. So let's move straight on to look at last year, or this year, the year that was. And on slide number 5 there, you can see the valuations of emerging markets versus developed markets on a trailing price to book basis since 2014. And as you can clearly see, emerging continues to be incredibly cheap versus developed markets. And that discount has only widened. And that raises the question in many investors' minds, why bother, or what's going to change in the future? Well, a couple of points to that, which I'll tackle later on. But this relatively poor performance for emerging markets masks a very wide dispersion on the next slide. And you can see here, which the slide is particularly difficult to read, but the blue line in the middle is the performance of emerging markets last year, which is down 0.27% in dollar terms. As you'll know, China fell dramatically last year, down 16%. Brazil did even worse, falling 19%, the green and the grey lines at the bottom. But elsewhere, some very good returns were to be had. India certainly has got a lot of press lately, delivering a 23% return, but Vietnam at 33%, Bangladesh 29%, Saudi Arabia at 24%, as well as in Eastern Europe, Hungary and Russia all delivered very strong returns. So money was there to be made if you looked in the right areas. And so on the next slide, how did we do in this environment? Well, our Alquity Future World Fund, our GEM fund, rose 4.4% in dollar terms versus the small decline in the index. That led to 470 bips of outperformance on a net basis and top quartile versus peers. That growth and outperformance came from being underweight China and Korea, our stock selection in China, India, and Korea, and in the case of Future World, an out of index position in a Singaporean internet company. Our Asian fund was similar, if not a bit better, rising 6.6% versus an index decline. And again, top quartile versus peers. Driven by, as you'd expect, similar factors, though our position in Vietnam, which technically is a frontier market, though we don't make that distinction, added a larger contribution in Asia than it did in Future World. Now at the bottom, we've shown our volatility rankings. And many of you who've been following us for several years know that whilst we've had periods of very good performance, our ESG process is second to none. Our stock selection is great, but our volatility has been too high. And we made an enhancement to our process over 2 years ago now by hiring Marnie, who has over 20 years experience in a quant analytical and risk background, who's really helped us with our portfolio construction. And that very small tweak has led to not just the much better performance that I just showed you, but also much lower volatility. Versus being some of the most volatile funds over a 3-year basis, as you can see there, we've actually delivered above index returns with below average volatility over 1 year due to those enhancements, which we're very pleased about. And continuing on the next slide in the same theme, more generally, how have we achieved this performance and why is it sustainable and repeatable? This slide shows our 4-stage process, which applies to our funds. And the first stage is the filtration. Now, this isn't based on an index. We find the best companies throughout the universe. We rule out the very small ones, but companies with a market cap of 100 million is our minimum. And that's a much lower cap than many of our peers. And that's been a great source of alpha as we've found these companies before everyone else piles into them. Themes. There are 3 core themes underlying our portfolio, and we are thematic investors. We're not just a collection of stocks. ESG red flags. There's a number of things, more than most people, that we will not invest in. Oil, coal, where there's ongoing controversies. The second stage is where we do our own proprietary analysis, both from a financial perspective, as well as our own rating on ESG. We don't use MSCI or Sustainalytics. So again, the ESG runs right through everything we do, but it's our own work. Stage 3, you can see there the quant and the risk framework that Marnie has brought in and the huge results that's delivered, as well as the macro analysis that our macro strategist Keith inputs. Keith joined us recently and has an over 20-year career in emerging market macro analysis. And then finally, the stewardship, which I'll talk on a little bit later in terms of voting engagement. So this process is what has enabled us to deliver that performance, and ESG is fully integrated into every stage. So having looked at what's happened in 2021, where do we now see the opportunities that are perhaps hidden in 2022 on the next slide? Well, firstly, on slide number 10, where are the potential catalysts for emerging markets? Well, firstly, the global economic backdrop remains benign. The US is going to taper and raise rates gradually. That's a perfectly fine environment for emerging markets. And although this isn't our base case, we can see why that could result in a weaker dollar, which is hugely positive for emerging markets. Turning to the asset class itself, we're expecting 5.1% GDP growth for next year. That's one of the strongest growth rates in the last 8 years. As I've already highlighted, valuations are cheap. We're also seeing a reduction of the China risk that's played out so much in this year, both in terms of its external relations with the US, which have stabilized and maybe improved marginally, and domestic risk, both on the macro and the political fronts. And given the performance divergence that we talked about a moment ago, increased investor focus on smaller markets also is a positive catalyst. Now, on the next slide, where do we see these long-term growth opportunities? And for us at Alquity, domestic structural growth themes dominate our portfolios, typically about 3/4 of them. You'll recall from stage 1 of our process where we talk about being thematic. Now, what are these themes? Well, the shift from the informal to the formal economy, India, Pakistan. The move from a physical to a digital world, China, Morocco, Poland. Decarbonisation, a couple of names there in Taiwan. Copper, you can't have a Tesla without copper. Urbanisation, Vietnam, Indonesia, and then demographics. Young populations in Saudi Arabia, Mexico, and much of Asia. So that's the headlines in terms of where we see the catalysts and the opportunities. Let's now delve a little bit more detail into country and stock insights in the next pages. Starting firstly with Indonesia, where the stable macro backdrop is underappreciated. Indonesia's had a very long COVID wave, and cases now are finally shrinking and the economy is reopening. You can see there with the PMI, dramatic increases over the last couple of months. And we expect GDP growth of about 5.2% in the next year. Unlike many emerging markets such as Brazil or Russia, inflation remains very well controlled, just 1.7% in October. And the large output gap will ensure the Bank of Indonesia doesn't raise rates anytime soon. The current account deficit has shrunk. Commodities are a positive tailwind for Indonesia, which is pretty rare in Asia. Strong fiscal position, stable politics enables further structural reform on top of what we've already seen to come through in the next couple of years. And this isn't priced in. Valuations are standard deviation below their 20-year average. In terms of stocks that we like, Mappy, which is a retailer, Kino, personal products, and Indo Cement, all of which are C-rated in our ESG process, are aligned to those domestic structural themes, such as demographics and urbanization that I talked about. Moving across to the next slide, this is a stock example from Pakistan called Airlink. It's the leading distributor, retailer, and increasingly manufacturer of mobile phones in Pakistan. We met them for the first time in 2018, and they recently listed. And there's a huge long-term potential here due to the underpenetrated market, as you can see in the chart on the top right. Smartphone penetration in Pakistan is only 18%, lower than Bangladesh, India, let alone Vietnam, Turkey, or the Philippines. And this is only going to go one way, as we've seen in country after country. So Airlink is a beneficiary of digitalisation and the shift to the formal economy. And that is an undiscovered stock. And the chart on the right shows a very interesting parallel. The yellowy-brown line is the share price performance of an Indian company called Reddington, which is in a very similar business that we've been following for decades. And whilst you can't really see it on the scale, investors have discovered this year and the share price has quadrupled. We expect in the fullness of time, the value that we see in Airlink also to be discovered by investors, and again, very strong returns as we've benefited from in India. Moving across to the Middle East now on the next slide, Saudi Arabia, a market that is wrongly ignored by emerging market investors. It's a big market, 34.8 million people, but many people don't have it in their portfolio. And we put it down to laziness by emerging market fund managers. This is a relatively new entrant into the asset class, and people prefer to stick with the names that they've known for 20 years, such as Brazil, Russia, etc. Well, for us in our filtering process, we look at every market in emerging markets, and that enables us to find opportunities that other people are missing. And here on the right-hand side, the population growth of Saudi Arabia is something that I think is perhaps much stronger, much higher than people realize. It's almost 2% a year over the last 5 years, very different from elsewhere in the Gulf, and actually much higher than markets like Indonesia and India, which are perceived to have fast-growing populations. Very high vaccination rate, almost 70%. And my colleague Dan is in Riyadh today and very much seeing that life is back to normal in Saudi Arabia, as indeed it is in the UK. In addition to the structural growth from the population, cyclical tailwinds from a higher oil price versus a year or two ago also help boost the economy. And we focus on banking, property, and retail. Now, moving into Europe on the next slide, a couple of hidden winners from retail digitalisation. Firstly, CCC, which is an A-rated company. It's the leading shoe retailer in Poland with a 30% market share. And they've transformed themselves over the last couple of years into an omni-channel with a much better e-commerce offering through their Ebuvia offering. Now, this is gaining very good traction online, but also they have a number of concept stores where you walk in and there's no shoes on display. It's all iPads, like an Apple store. And they can scan in a 3D image your foot size to enable you to choose the perfect footwear. And this is gaining significant traction, and their growth is really coming now from Western Europe because there's very little competition in this space. And it's trading at a 50% discount to peers. And the picture you can see there, the bottom left, is myself visiting their warehouse in Western Poland a few weeks ago. I was also in Russia the week before last on the right-hand side, meeting with Fixed Price, which is a C-rated company. Now, in Russia, we have intense competition between physical retailers who are moving into e-commerce and e-commerce companies who are increasingly moving into retail. And we're at the maximum point of aggression. There's no consolidation. People are burning cash to a very great degree. Now, Russia also is getting poorer, and the fastest growing segment in the retail area is discount stores, a bit like B&M in the UK. Fixed Price is the leader in this space, a 90% market share, a sustainable competitive advantage due to its first mover, structural growth because it's in that segment of the market, and immune from the aggressive e-commerce related competition that we're seeing elsewhere. Because you're not going to buy a cheap tube of toothpaste online. You're going to go to your neighborhood store. So they've got a very strong moat against e-commerce. Finally, moving across to Latin America on the next slide, we're positive on Mexico and concerned on Brazil. Mexico benefits from our themes of favorable demographics and the shift to an organized economy, and the US cyclical recovery with a higher oil price are further tailwinds to that structural story. Our preferred names are Walmex, a retailer, and Azur, which is the airport operator in Cancun, which is benefiting from the opening up post-COVID, particularly in America. In terms of Brazil, it's a very different picture. Fiscal risks are mounting, the fiscal discipline has gone out the window, and political risks are growing ahead of the 2022 election, which will be highly polarized. Interest rates have already increased from 2% to 7.75% this year already, and we're expecting a peak of 12%. And you can see the sovereign yield has also increased dramatically on the right-hand side. So we've been reducing our exposure to Brazil. Now, I've deliberately not talked about China and India, focusing on where we've seen much better opportunities in this year. Now, let's now talk about these two markets and the outlook for them in 2022, starting with India. Activity is rebounding strongly. The economy is reopening, and we've had the third successive monsoon. We're expecting 9% plus GDP growth this year, 7.5% next year, with controlled inflation and a continued accommodative monetary policy. The current account will only be a modest deficit despite the higher oil price. Valuations on the right-hand side have dramatically increased, and they look rich, with the price to book on a trailing basis being the highest for many years. But they are justified given the strong recovery and the long-term growth themes in terms of demographics and the shift to the formal economy. We still see value in the banking sector, tractors through Escort, and Hero Motor, which is a motorbike manufacturer. And the key event is the Uttar Pradesh elections in February, March next year, which is the Hindi heartland. Modi is expected and looking likely to do incredibly well. If he doesn't, then that would be a concern. So that's the next point to keep an eye on in terms of that market. As many of you know, on slide 20, we also run a dedicated Indian fund. And again, here we focus on our long-term themes. That means on the left-hand side, we have a greater weighting to the smaller up-and-coming companies in India that are benefiting from that shift from the informal to the formal economy, demographics, urbanization. And that's worked really well for us. The performance on the right-hand side in terms of percentiles shows that year to date, we're almost in the top percentile. Over 3 years, we're about average. 5 years, just below the top quartile. And since inception, that's 7 years, nicely in the top quartile. So it's performed very well for us due to that strategy of focusing on long-term themes. In contrast, China on the next slide has suffered from multiple issues in 2021. The regulatory crackdown that began in the tech sector has expanded to a theme of common prosperity. And we've seen restrictions on US IPOs, anti-monopoly investigations, constraints on private tutoring, etc. But this isn't designed to squeeze the middle class. It's about the super rich billionaires who've become a bit too powerful. And the mood music in Beijing has changed in recent weeks to focus more on economic growth rather than regulatory crackdowns. Similarly, Evergrande, the property company, has led to concerns over broader financial contagion. Most large developers are not on the brink of a liquidity crisis. The fears are overdone. And again, we've seen government moves over the last couple of weeks to increase liquidity availability through the domestic, onshore and banking markets to the sector and accelerate mortgage growth as well, which obviously help the companies too. Power rationing, we're now seeing that ease. But China is still in pursuit of a zero COVID strategy. They have a very high vaccination rate, and so it's a political choice to keep the borders closed or semi-closed for the time being. Now that doesn't really impact growth because the majority of China is actually domestic economy. But this is the next thing that needs to change in 2022. Having said all that, on the next slide, the bad news from this year is very much in the price. This shows China, the 8 shares, trailing price to book, and we're at the bottom of the range for many years. And as I've just alluded to, we can see signs of that turnaround happening. And we believe that this market is too cheap, and we've certainly been adding over recent weeks. The next slide deals with a question that we're often asked is, how can you be an ESG investor and invest in China? Well, firstly, we naturally focus on lower risk areas. We screen out almost 40% of companies in China, reasons on the right-hand side, such as governance, worker safety, state-owned enterprises, etc. We tend to be positioned in insurance, retail, internet names. The issues that gain the headlines in China don't tend to be in those sectors for obvious reasons. Now, renewables is perhaps an interesting example of that clearly solar panel manufacturers is great in terms of the climate change crisis that we face. But so much of the solar panels come from the Xinjiang province where Uyghurs are used as forced labor. And so we don't invest in this area at all due to those concerns, unlike many so-called sustainable funds. As we've mentioned before on these webinars, Hong Kong listed companies actually have best-in-class sustainability disclosure, which is perhaps a surprise. And now that President Xi has come out with carbon targets, it's a really helpful backdrop for our corporate engagement. President Xi has said this, what are you doing to meet his targets? And that plays very well in a country like China. So now let's move on to a little bit about why we're uniquely positioned to take advantage of the opportunities that we see in emerging markets over the next year. And firstly, label ISR. And for those of you who've met me a number of times, I'm sorry to mention this again, but it is absolutely crucial, particularly because every man and his dog now talks about doing ESG. We've done the ESG, it's fully integrated since day one. That's all we do. but we're also certified. This is the French label. It's the strongest label that we've seen, stronger than the Belgians or the Luxembourg one. And we don't have one here in the UK. And they come and audit us for 2.5 days every year. We've done that for 4 consecutive years. So whilst everyone's talking about ESG, our process is certified by the highest standard that we can find. And that should give investors confidence that we mean what we say. And you see that on the next slide, where we talk about Samsung. Now, for us, Samsung is an ESG fail. It's the 4th largest weighting in MSCI Emerging, and it's a popular holding in so-called sustainable funds. They have a very nice glossy ESG report. But there's a multi-year pattern of criminality. The current leader, Jay Lee, has been jailed and released a couple of times and is again under investigation for accounting fraud and share price manipulation. His father was convicted twice. They tried to clean up the board, but the previous independent chairman, no relation, was also convicted, and the current one has also been investigated. Now, many investors go, well, there's 6 out of 11 directors are independent. That's a majority, box ticked. But the directors are very lightweight. They're academics, they're journalists, they're lawyers. They don't have the power or the ability to stand up for minority shareholders. Look at Taiwan Semi, similar Asian massive company, but they have 5 directors who are CEOs or ex-CEOs of global companies in the UK, Israel, Taiwan. If Samsung moved to that where there was effective governance, we'd change our mind, but they don't. They're not serious about shareholder rights. On the next slide, I'd like to share with you where we see the ESG journey going. And it's going to be the confluence of ESG and impact. We've always had impact in our process, our key progress indicators, where we want all our companies to provide disclosure of various metrics. We've been engaging with our companies and having some success, particularly given our size, over the years. And of course, we have the Transforming Lives Foundation as well. But we're now going to start publishing data of our GHG and our water uses of our funds versus that of the index towards SDG 6 and 13. And you can see here that for all 3 of our core funds, the GHG is lower than that of the index, and the water usage is lower as well. So we're having a very clear impact through our portfolio now as well. And I don't see many funds in the UK particularly, and some in Europe, but not many still, producing this level of disclosure in emerging markets, particularly given our focus on smaller markets and smaller stocks. Continuing with the differentiation theme on the next slide, the big 4 Asian markets, China, Korea, Taiwan, and India, represent 75% of our Asian fund. Some of our big name competitors have 95% in these 4 markets. Most of them are ignoring the smaller markets that represent almost 1 billion people. This gives a greater source of growth and diversification. Expanding this out to emerging markets, so in the big 6 markets, including Brazil and Russia, is 63% of our future world funds. It's 88% of some of our peers. We're invested in 21 markets, providing broad exposure and extensive diversification. Small and mid-cap stocks are 30% of our fund. It's a controlled exposure and has been a good source of alpha generation for us in the past and including this year. And you can see all this on slide 29 in terms of our portfolio characteristics. Both Asia and Future World have cheaper valuations than that of the index with higher ROE. So whether you're an ESG investor, an impact investor, or just a regular investor, this is a compelling proposition due to these stats, regardless. Now, to conclude, growth tailwinds are persisting. That's positive for emerging markets. There are catalysts and we're cheap. At Alquity, we're thematic investors. Themes run throughout our funds. We're not just focused purely on the index, and we're not just a collection of stocks. There's a theme behind it. We believe in ESG. It's fully incorporated in every stage of our process. It's not just a bolt-on. We have a real impact. We're differentiated, smaller markets and stocks, and a domestic focus. We're fundamental, delving behind the headlines to find hidden opportunities, as I've illustrated. And we're delivering across our product range. So thank you very much, and very happy to take questions.
So thank you, Mike. Mike doesn't have a video today. I'm sure that's my fault, but you can hear him speaking and he'll answer the questions clearly, I'm sure. So that's all for the good. There's a number of questions. Thank you in particular to the person who's got good questions on the chat function. I won't name you, but as I'm seeing you next week, we can have a little chat about that directly. The questions range from macro, country specific, sectorial, COVID question, and ESG. I guess we'll start with some of the macro first, and we'll get this through in the next 10, 11 minutes, as we sort of promised at the beginning. I thought this was a very good question. Mike, you stated that emerging markets are quite good valuations, i.e. low. The question is, why is low valuation a good indicator? When we look at the S&P 500 valuation, they've never been higher, and yet the index still outperforms. I know you'll like that question.
It's a great question, and we do get it a lot. So you need catalysts for emerging markets, and we've identified a number of those for the next year. Now, in terms of valuations, the composition of emerging markets has changed dramatically over recent years. It's no longer dominated by commodities or financials. Tech actually has become a much bigger part of that. And so a comparison between S&P and emerging is actually more fair these days than previously, because the sector composition is more similar. And the growth rates in emerging are much higher than you have in America. So you have similar sector dynamics, stronger growth, and cheaper valuations. Now, for the long-term investor, I believe that's a compelling proposition. The question is, what makes investors start switching? And that's perhaps the great conundrum. And having done this for 25 years, it's always really hard to call that. We've identified a number of things. Perhaps it will be the fact that the Fed raises rates gradually, and many emerging countries are doing it a bit faster, and that could lead to dollar weakness. It could be Biden's tax policies. It could just be people start recognizing the growth. You can never quite call that turning point, but it's hugely important, if the fundamentals support it as they do, to begin building those positions in emerging markets sooner rather than later. Because one thing we do know in markets, particularly these days, the power of momentum, and when it turns, it will turn powerfully and quickly. You're on mute, Alex.
Sorry, coming off mute. I'm working from home. There's always a risk that there's a noise behind me, so I should watch out for that. I'm sure you're all used to it. Also macro. Have you been adding to China and reducing India? Question. I think we know that's true. Why do you think that domestic risk has diminished in China?
So yes, we have been reducing India, only gradually recently. As we said, the valuations can be very much supported by the growth outlook we see, as well as the long-term themes. But as we've highlighted, there's a lot of value elsewhere. And so in a GEM and an Asian fund, we've rotated where we see great opportunities, that being China. In terms of the domestic risks, China doesn't come out with big, bold statements. It's about changes in direction and press articles and reading the tea leaves, if you like. And the mood music over the last couple of weeks has improved. So the clampdown on the tech industry has not intensified. It's stabilized and the news flow has diminished. In terms of common prosperity, it's been clarified that this isn't a squeeze of the middle class. It's about getting the middle class to be richer, but stopping having the multi-billionaires at the top, which we're absolutely fine with. That's very good for the portfolio. So a number of things where the wording has gradually changed. And in terms of the property sector, which is perhaps the biggest risk that everyone always talks about with China, the opening up of liquidity sources domestically which is controlled by the government, again, supports the economy. And the central leadership has started talking about stability as being the key, rather than clamping down on regulatory issues. Now, it sounds quite nebulous, but having invested in China for decades, this is how China works. And as the mood music changes, you don't read it in the FT perhaps, that's when you start changing your position. So that's what we've been doing.
Thanks, Mike. A lot of questions here today. You guys are very good. A question about a comment that you made in the presentation. You said that we're thematically investing. So the question is, could you be more explicit about those themes, please?
Sure. So it's one such as domestic structural growth and the sub-themes below that. So companies that benefit from urbanization, for example. So let's take the banks. In Korea, it's a very highly urbanized society already, and everyone has a bank account. In India, that isn't the case. In Pakistan, that definitely isn't the case. And so as people move into the cities, away from keeping their money under the bed in the rural areas, they're going to open a bank account. That's a structural growth driver. Equally, the shift from the informal to the formal economy, again, India being a key point in that, means that people don't transact in cash. They want to have a bank account. And so we screen in companies that benefit from that, such as Indian financials, and we would screen out companies such as Korean and Taiwanese financials, where you don't have that structural growth driver. Now, that's just one sector, but that's perhaps a very good illustration. And the key themes within it are, so the shift from the physical to the online economy. So a company like Tencent, Meituan Jiangping, Waymob, Kakao, they would benefit from that. In less developed markets, as I mentioned, the shift from the unorganized to the organized. Decarbonization is an increasing theme. So Delta produces energy efficiency equipment, and Century Iron and Steel produces the jackets and pins for offshore wind turbines, the bit that goes under the water. So again, a long-term theme, and that's a domestic theme given the nature of the market in terms of Century. Demographics, young populations consume more, and Saudi Arabia, Asia are like that. Somewhere like China, you don't have that young population, but you use insurance more perhaps as you get older. You care more about these things. And therefore, we own an insurance company in China playing the theme of demographics, but from the other perspective. So hopefully that gives a little bit more granularity to that.
Thanks, Mike. As I say, a lot of questions here. I'll just switch tack a little bit and move to ESG, and I'll try and combine these questions, which is probably dangerous. We've got an investment, you've mentioned Saudi Arabia a number of times, and the question is, with negative views on human rights in the Middle East, including Qatar, Saudi Arabia, etc., how does that match with your ESG views? That's part one. And part two is, though you did mention this, but maybe you can expand on it, does the fund have any external ESG ratings? I know the answer to that, but you might want to give a view on where it's going in the UK. So the first bit's about the Middle East and human rights. The second bit's about ESG, what we have now, what might be coming.
Sure. So Saudi Arabia does have issues with that, as we all know. But firstly, all emerging markets have issues in various areas. And so I wouldn't particularly single out Saudi Arabia. China, human rights in terms of its Uyghur minority, as I just mentioned, with the solar panel companies. Do you want to own those when the production is made by forced labor? We don't, but many people do. Russia has a huge problem with corruption. So we look at each country on its own merits, and there's very few that are perfect. This isn't Switzerland. And in Saudi Arabia specifically, or with any country, if companies cannot be run for the benefit of all stakeholders, that includes workers as well as shareholders, as well as the environment, then we will not invest. So when Myanmar suffered their military coup a while back, we immediately exited because we knew that despite how good our company was, they would not be able to deliver for stakeholders in that environment. So in Saudi Arabia, we have a couple of positions. And Dan literally yesterday was visiting the sites of one of them and spends an hour discussing the treatment of workers with them. We believe that whilst you can do a lot of analysis sitting at your desk, you have to go out there and kick the tires as an ESG investor. And that's exactly what we did in Saudi Arabia for exactly that reason. And Dan is very happy with the company. If he wasn't, then we would have engaged and exited it. So that's where we are on Saudi. In terms of the second part, so our biggest challenge is that we're a firm that is not particularly well known, and many of our companies don't produce the data that ratings agencies from an ESG point of view like. And so what we've done is taken some data and cleaned it up, and that is why we're now able to publish data for RGHG and water. But rating agencies that just take data from outside and just give us a rating without any engagement or talking to us, we tend to be above average, but we're not as good as, we're not coming across as well as we should be. And that is something that Alex and Suresh are working on. And I know that in the UK, one rating agency has taken a new look at us, pushed by one of their clients, and we've dramatically gone up the ratings as a result of that. So we're good by the rating agencies, but when they really look at us, we come out to be very good, which is where we want to be. Alex, I don't know if you want to add anything to that from a sales perspective.
I think it was a great answer. I'll name the latest one that reviewed us and then gave us a better rating. That was Worthstone, so free advertising for them. But we feature as one of their top 10, the Future World Fund to be specific, as one of their top 10 funds over the last quarter. So as Mike suggested, we need to engage more with some of these agencies, because quite often when you look at the data they use, it's old and it doesn't make sense. And I suspect that they've thought they've had better things to do because everyone has limited resources. We need to raise our profile with them. We will do that. But let's quickly move on. We've got a couple of minutes. There are a lot of questions. Let's get something more specific here. And again, I'll try and merge these questions together, two sectorial questions. Part one, are you worried about the semiconductor cycle turning over and a potential glut in semis? That's part one. And part two, very topical, there's been a flurry of tech IPOs in India. Is there a lot of speculation here, i.e. pay TM?
Sure. So the first one, we look at the semi cycle like any other commodity. So it's perceived as all very kind of sexy due to it being tech, but it's a commodity. And we model it accordingly. But no, the answer is that we don't see that glut yet. We see some weakness in this quarter, which is very well priced in, but then we see another strong year next year. So our tech hardware positions in various parts of the chain, such as Lino, TSMC, and Hynix, we're very happy with going into 2022. In terms of the second part, I've completely forgotten what it was, Alex.
Indian IPOs, flurry.
Oh, thank you. So yes, Paytm has been a disaster. We analysed it and we were not happy with the business model, particularly given the regulatory risk as well, and that's come to pass. So we have no exposure there. India and tech is a great combination in terms of words. It attracts investors in. That doesn't mean it's a good business. And we correctly identified the issues and we've avoided it. We look at every company on its merits. We have internet-related businesses in Singapore, in China, in Korea, etc. And we just didn't think that the reality met the hype, and so we avoided it.
Thanks, Mike. I'm leaving quite a lot of questions on the table here. I do like to finish on time if possible. I will squeeze in two more questions into one, and then the remaining questions, I'll get your representative to come back to you directly to give you the answers. So forgive me for that, please. So let's get the one merged together. Do we have exposure in Vietnam and the Philippines, which seem to be at an early stage of the growth curve, especially the Philippines? And also, can we elaborate a little bit more on the Vietnam valuations and are they justified? So Vietnam, Philippines, valuations, early stages of growth curve, how are they justified?
So yes, we do have a little bit in Vietnam in both the Asian and the GEM fund. They had an amazingly good start to COVID, then it didn't go so well. They then opened up and cases are rising again. So we're cautiously optimistic. We have one beverage company and a property company, depending on in which fund. The long-term story for Vietnam is brilliant, though COVID is causing it to be a bit bumpy. In terms of valuations, the market has done incredibly well, as I showed at the start, and that's led us to take profits given the slightly bumpy short-term outlook. So fast forward 3 years, it's an amazing opportunity. Near term, a little bit more cautious, just for the reasons I mentioned. We have some small exposure. It's probably the smallest we've ever had. And if opportunities present themselves, we will increase that. The Philippines is something that we find much more attractive. So I'd probably split Vietnam away from the Philippines, but I'd add Indonesia in the same bucket. They had a very long and damaging COVID wave. They're both now coming out of that. Valuations are attractive, growth is accelerating. And so we have substantial positions in both those markets, and we're really quite excited about them. And market momentum seems to also be turning in favor of our positioning there.
Okay, thanks, Mike. I appreciate people's patience in staying on. I will literally ask one more question and, as I say, get back to you. If you run out of time, I'll forgive you for leaving, but the last question is about the Future World, the Emerging Market Fund, and our Asia Fund. We've mentioned stocks in Indonesia and Pakistan, so quite small markets. Indonesia didn't need to be. But what's the crossover of those markets in both funds?
Sure, Alex, please go forward to 2 slides if you can control it. And so you can see the asset allocation there. Broadly speaking, Asia is around 75% of GEM, give or take. So there's a huge crossover there. Every stock in Asia in the Future World Fund is also in the Asian Fund currently, plus 2 or 3 others as well that are in Asia, but not Future World. And so the way this is positioned is if you want the very broad GEM exposure, 21 countries, you have a Alquity Future World. And obviously a large chunk of that is Asia. If you want Asia specifically, then we have that fund. And we have our Indian fund, which is a satellite to either of those 2 core funds. So you can have Future World in India, Asia and India. That works very well. But clearly, if you want GEM, you go Future World. If you want Asia, you go Asia. High crossover between the 2 of them.
Thanks very much, Mike. Thank you very much to everyone that attended. You stayed for the whole of the presentation. Really appreciate that. As I mentioned, you have various representatives for your geographical area. Please do use them for any more information you need. We will come back to the questions that weren't answered. There were a few. I'll make sure that happens. Thanks very much. Hope to see you soon. Goodbye.